Guys, price charts sometimes show moments where the market starts to swing more wildly. One pattern that appears during these periods is the expanding, also called broadening, triangle pattern. The broadening triangle chart pattern develops as prices widen instead of narrowing. Higher highs and lower lows emerge across the chart. This structure looks exactly like a megaphone. The rising line acts as resistance, while the falling line functions as support. The expanding triangle formation has two main types. The first main type is the symmetrical expanding triangle chart pattern. Both the upper and lower trend lines move away from each other. This pattern can appear during uptrends, downtrends, or even sideways markets. Traders also encounter two variations of the symmetrical expanding triangle pattern. These versions are known as the bullish symmetrical expanding triangle and the bearish expanding symmetrical triangle. A break above the upper trend line points to a bullish version. A move below the lower trend line signals a bearish version. Direction comes from the breakout side. The second group includes right-angle expanding triangles. One side stays flat while the other side expands over time. An ascending expanding triangle pattern has a flat support line and a rising resistance line. Buyers push prices higher with each swing. A descending expanding triangle pattern shows a flat resistance line and a falling support line. Sellers apply stronger pressure as price moves lower. Guys, now let's talk about how we plan a trade after a bullish breakout in an expanding triangle pattern. After price breaks above the upper resistance line, it often makes a short pullback. Staying patient instead of rushing gives a big advantage here. The safest entry comes after price confirms strength following the retest. When price holds above the old resistance line and continues moving upward, an entry becomes valid. Stop-loss placement is very straightforward. The stop usually goes slightly below the broken resistance line. This way, if price unexpectedly moves back inside the formation, risk stays controlled. Target calculation relies on the height of the pattern. Measure the distance between the highest high and the lowest low at the widest part of the structure. Add this distance to the bullish breakout point. This approach defines the target in a logical and measurable way. Guys, now let's apply the same logic to a bearish breakout. After price breaks below the lower support line, it often reacts with a short upward move. This reaction usually appears as a retest. For entry, the healthiest approach is waiting for price to continue moving downward after the retest. A sell entry becomes valid while price remains below the broken support line. Stop-loss placement goes slightly above the former support line. This position helps protect the account against false moves. Target projection again uses the height of the formation. Measure the widest price range and subtract this distance from the breakdown level. This creates a target that feels structured, objective, and free from emotion. Guys, some traders start trading an expanding triangle as soon as it begins to form. They do not wait for the breakout. Instead, they focus on price movement inside the structure. With this approach, traders look to buy when price reaches lower levels near the falling support area. They look to sell when price moves toward the higher swings near the rising resistance line. This method allows them to trade the swings inside the expanding range. There is an important detail here. Volatility keeps increasing inside expanding triangles. Stop-loss levels need more space, and position size must match that risk. Experienced Forex trading traders often use this style for short-term trades. One key rule stays the same. The pattern can break at any moment. When that happens, open positions inside the structure can turn risky very fast. That is why traders who trade inside the formation stay alert as price moves closer to a breakout and manage risk very carefully. Guys, one of the biggest mistakes in expanding triangle patterns is entering the trade the moment a breakout happens. Most of the time, these breakouts are false. Price moves outside the structure, then a few candles later, it comes right back inside. That move usually traps impatient traders. So how do we avoid this? First, watch the candle closes. Price can break the level, but if the closes look weak or unclear, be careful. Second, check momentum and volume. When there is no real participation, price often fails to continue. The most important part is the retest. How price reacts at the old support or resistance shows the real intention. Experienced traders do not enter on the breakout itself. They wait to see what price does after the move. If price cannot continue after the retest, it is often a liquidity grab. Broadening triangle patterns reward patience and clear rules, not fast reactions. Friends, let's take a look at some real chart examples and see how this works in actual market conditions. Here we have a real market example showing an expanding triangle pattern developing over time. Price moves with wider swings on both sides, showing that volatility keeps increasing as the pattern forms. The lower boundary of the expanding triangle gets broken to the downside. Sellers step in strongly, pushing price lower right after that breakdown. After this first move down, price does not continue straight away. A pullback starts and price moves back toward the previous support line. This level used to act as support during the pattern formation. After the breakdown, the same line works as resistance. Price reaches this area and struggles to move higher. Buyers fail to push price back inside the expanding triangle. Once price turns lower again from the retest area, the entry is taken. This entry comes after sellers regain control and downside momentum builds again. The stop loss is placed slightly above the old resistance line. This placement limits risk if price suddenly moves upward and invalidates the setup. Target calculation follows the structure of the pattern. The height of the expanding triangle is measured from the highest swing to the lowest swing. That distance is then projected downward from the breakdown area. This gives a realistic downside objective based on previous price behavior. After the retest, price continues moving lower and follows the projected direction. The market respects the pattern structure and reaches the target area step by step. This example shows how patience during the pullback phase can improve trade execution. Waiting for the retest allows entry closer to resistance and offers a better risk-to-reward profile. Friends, let's look at this second chart together because this one is a classic fake breakout example inside an expanding triangle. Price moves up and briefly pushes above the upper resistance line. At this moment, many traders may think an upside breakout is happening. But when the candle closes, the story changes. The candle body closes back inside the pattern, below resistance. Only the wick stays above that level, which tells us price was rejected from higher levels. Buyers tried to take control, but they could not hold price above resistance. After this rejection, price returns inside the expanding triangle. From there, selling pressure builds and price moves toward the lower boundary. Eventually, the lower support line breaks and price starts moving down. Instead of an upside breakout, the market chooses the opposite direction. This is a good reminder that expanding triangles often produce fake breakouts, especially near key boundaries. Guys, this third example shows an expanding triangle chart pattern on a real market chart. The support and resistance lines of the expanding triangle are already drawn and price has respected these boundaries for a while. Price moves upward and approaches the upper resistance line step by step. Buyers stay active and pressure keeps building near the top of the pattern. Then price breaks above the upper resistance line. This breakout happens with strong momentum and without hesitation. There is no pullback after the break. Price does not come back to test the old resistance level. Instead, price continues moving higher and turns into a fast rally. Sellers fail to push price back inside the expanding triangle. This kind of movement often catches traders off guard. Many traders wait for a retest, but the market does not give that chance here. The move continues upward and distance grows quickly from the pattern structure. Price keeps pushing higher as buying pressure stays strong. Guys, this example shows how an expanding triangle chart pattern can break upward and continue without any pullback. Guys, if you enjoyed this expanding triangle content, make sure to like the video. Subscribe to the channel for more real chart examples and pattern breakdowns. Also follow the page so you don't miss upcoming videos and market analysis. See you in the next one.